So today I want to talk to you about what we call an assignment of a policy. Now remember that when you're assigning a policy, you're technically giving the policy away. Okay, there are two ways of assigning a policy, and we'll of course talk about both of them. The first one I want to talk about is what we call the absolute assignment. In an absolute assignment, what really happens is you're giving the policy away. So basically, there's no consideration or anything on the line, just simply here's the policy, and that's the end of it. Now remember that when you absolutely assign a policy, basically you no longer own it. So you may own it now, so in other words, it's a personal policy, or you may own a policy on somebody else, whatever, a third-party policy, all those things are available. The point is you're the one that actually owns the policy, so you have all the control. So now you're saying, okay, I no longer need this, or I want to give it away, or whatever the case may be, okay? So the question now is, I'm going to transfer that policy on an absolute basis, which basically means I'm done with this and that's it. That's easy enough, as we know that when that happens, okay, the beneficiary designation, all those things there all have to change at that point. In other words, an absolute assignment changes the beneficiary automatically, okay? So, however, when we do this, there are two things that are very, very important when we assign the policy. The first one I want to talk to you about is what we call an arm's length transaction. The word arm's length is really key here, because we're saying about arm's length, we're technically giving that policy away to a stranger, you might say, somebody that is not necessarily blood related. Also, it could be a sibling, in other words, give it to your brother, your sister, your uncle, your cousins, things of that nature there. In other words, they're not sort of, your own personal family, essentially. So a stranger or a sibling, these will be what we call arm's length transaction. And there are some serious tax implications when you actually transfer a policy in an arm's length transaction. Then we'll look at the non-arm's length transaction, which is basically you're giving the policy to your spouse, to your own children, to your grandchildren, great-grandchildren, things of that nature there, okay? So the tax implications of both of these are quite different, okay? From an arm's length to a non-arm's length transaction, the tax implications are quite different. So let's take a look first at the arm's length one, which is the one that probably gives most grief to people. Okay, so we'll look at arm's length, and we take an example here. We've got Jack. He owns a policy on his wife. Okay, so it's a third-party policy. He owns whatever $200,000 policy, let's say, on his wife. Jack also happens to be the beneficiary. He decides one day that he wants to transfer the ownership of that policy to his brother Jim. It could have been a stranger, it doesn't really matter, okay? But in other words, he's transferring it not to his spouse, not to his children, he's transferring it to somebody outside of that, so the branch of the tree, you might say, okay? So he's transferring ownership to his brother Jim, okay? At the time of the assignment, okay, what was happening at the time that actually this happened, the adjusted cost base was $34,000. So there's your bottom line was $34,000. The cash surrender value, or the fair market value of the policy at that time, was $61,000. So if you know from previous videos that you may have watched, there was a policy gain. The moment you transfer a policy on an arm's length basis, that basically means now you dispose of that policy. There is a deemed disposition of that policy. So there's a policy gain, which in this case will be $27,000. And how we arrive at that is, of course, the difference between $34,000 and the $61,000 is your $27,000. Okay, so basically at that point, Jack has essentially a gain, okay, a policy gain of $27,000, which he has to then report on his T4s, T1s, whatever, that sort of thing. He has to report that as income. And then based on Jack's assumed marginal tax rate, he has to pay the appropriate amount of tax. So for example, if it's 35%, that's his tax bracket, so 35% of $27,000 is in the neighborhood of around $9,200 that he's going to have to report or pay as tax. So the moral of the story basically is what we're saying is that when you transfer policy on an absolute basis, and it is an arm's length transaction, there is a deemed disposition. So when the person, in this case here, Jack, actually disposes of that policy, he has a gain in that, and therefore the taxes are going to have to be paid. And so therefore, in this case here, it was $27,000 times, again, like I said, he's the marginal tax rate, and he has to send that check to Ottawa, basically. The interesting thing is, however, now that Jim now owns that policy, okay? Jim, of course, will name himself, let's say it's a beneficiary, or somebody else, that's up to him, because now Jack no longer owns that policy. Jim owns that policy. So because he has acquired it now at that point of transferring and everything else, his adjusted cost base now is $61,000. In other words, the tax is already being paid by Jack up to that $61,000. At that point, Jim now takes over that policy. So now his ACB, his cost of acquisition, you might say, is $61,000. So his ACB is now $61,000. So at some point, Jack disposed of his policy somewhere down the line, 5 years, 10 years, 20 years down the line, whatever it is. Whatever the difference is between the cash value, the fair market value of the policy at that time, and the $61,000 that he actually acquired it for, that difference again will be the policy gain. So the first $61,000 will be tax-free because tax already been paid. You don't want to have double taxation, obviously. So we'll definitely, yes, that'll be taken care of already. So basically, at that point of the new disposition, you might say, when Jack cancels it or disposes of it or however he does, the gain between the $61,000 and whatever the value is at the time that Jim actually disposed of the policy, that will be the new policy gain. And of course, new taxation will have to be paid on that. But up to the $61,000, he does not have to worry about that at all. Okay, so that basically is the taxation of an absolute transfer. Now, at arm's length, that is, okay. Now, something else to be noticed on this here is that in this case here, it was done while Jack was alive. What if Jack had died and the contingent owner was still his brother, Jim? So even though it was a death benefit, in other words, the transfer actually didn't happen while Jack was alive, it actually happened when Jack died, exact same rules apply. In other words, Jim now becomes the new owner. So Jim is the successor owner or contingent owner, let's say, of the policy. So Jack dies, now Jim owns that policy. Jack's estate now has a capital gain, basically a gain of this, and it'll be the exact same thing. So whether you're actually transferring the policy while you're alive, or when you transfer when you pass away, the same rules apply. There is a deemed disposition at that point. So whether your deemed disposition is while you're alive, in this case, in our example here, or let's say that Jack died, an exact same scenario happened here where the ACB was $34,000, CSV was $61,000 upon his death, let's say, there'll still be a policy gain. This time, however, the policy gain will be to Jack's estate. Okay, so the estate will have a tax liability of from say 35%, let's say at $27,000, same thing. And once again, Jim would receive the policy at just the cost base of $61,000. So moral of the story basically is that whether you're living, whether you transfer the policy while you're alive, or whether you transfer the policy upon death, there is a deemed disposition, and the tax implications are the exact same thing. Whether you're living or whether you're dying, there is a disposition, and taxes will have to be paid. And now the new owner will acquire that policy based at the new ACB. So once again, all future growth down the line, when Jim finally does get rid of the policy himself, okay, then that policy will be a gain. So the next thing we're going to look at, of course, is what we call non-arm's length